Welcome back to the deep dive. If you're looking for a shortcut to understanding, well, the complex maneuvers of global pharmaceuticals, you've definitely come to the right place. Today, we are tearing into the Q2 fiscal year 2026 results for Dr. Reddy's Laboratories, or DRL. Our mission today really is to analyze what looks like a high-stakes corporate tightrope walk. We're tracking how a massive pharma company manages a fundamental strategic pivot. Navigating the guaranteed financial cliff edge from the decline of their big blockbuster generic, lenalidomide, and at the same time, proving they have viable, sustainable growth levers already working.
Exactly. We're not just reading numbers off a page here. We're watching a company fundamentally shift its business model, moving away from relying on, a few massive, high-margin U.S. generic wins to building a truly diversified global engine. The sources, they paint a picture of, let's call it, a controlled demolition and a simultaneous reconstruction. We really need to see if this diversification is strong enough, to counter the immediate U.S. losses, and if their big pipeline bets are concrete enough to eventually restore those lost margins.
Okay, let's unpack this. I like the analogy. It's like changing the tires on a car while it's going 80 miles an hour, isn't it?
Yeah.
They're trying to keep up speed despite a major structural issue, really, in their North American business. So let's start with the overall financials for Q2 FY26. Okay, the top-line figures, they look pretty robust on the surface. DRL delivered consolidated revenue of 8,805 crore, that's just shy of $1 billion US, $992 million. And it represents near double-digit growth year-over-year, about 9.8%. Other health markers look decent too. EBITDA margin at 26.7%, annualized return on capital employed, ROCE sitting comfortably around 22%. And a healthy net cash surplus, about $310 million.
Yeah, those are the numbers that grab the headlines, definitely. But the real story, as always, is in the segments. The U.S. generics market, which has historically been their profit engine, well, it's flashing red. North American generics revenue actually declined, a pretty painful 13% year-over-year, dropped down to 3,241 crore.
And we really can't stress this enough, can we? This is a direct result of that lenalidomide effect wearing off. Plus, the continuous sort of gnawing erosion of prices on specific U.S. generics.
And this leads directly to the core challenge you see on the balance sheet. The gross profit margin, it dropped substantially, down to 54.7%. For those of you tracking margins closely, that's a 492 basis point decrease year over year. That's huge.
Yeah, nearly a 5 percentage point hit. That really confirms just how profitable and, frankly, irreplaceable lenalidomide was in the short term. The U.S. generics pressure is definitely real and immediate.
Right. And it wasn't just market erosion hitting those margins, was it? Management made some strategic cleanup decisions this quarter, too.
Yes, exactly. We saw the impact of discontinuing certain pipeline products, specifically conjugated estrogen.
Yeah.
Can you maybe walk us through the financial fallout from that decision?
Certainly. They took some significant one-time inventory provisions. This was due to technical challenges related to stopping that product line. And that ties into an impairment charge, about $535 million, for property, plant, and equipment at their Middleborough facility. That's really the necessary financial pain they're taking now, cleaning up difficult assets for cleaner books going forward.
Okay, got it. And they also mentioned lower operating leverage in the TSAI segment. For listeners who might not be steeped in all the pharma jargon, what exactly is PSAI, and what does lower operating leverage mean here?
Good question. PSAI stands for Pharmaceutical Services and Active Ingredients. This is the part of the business where they manufacture the key raw materials for many of their drugs and sometimes sell those APIs to others. Lower operating leverage basically means the fixed costs of running those manufacturing plants, things like utilities, maintenance, staff, they rose faster than the revenue generated by that segment this quarter. So essentially, their manufacturing machinery wasn't running as efficiently, which added a bit more downward pressure on overall profitability. Minor, but noticeable.
So lenalidomide is effectively done then. Management confirmed it'll continue a bit in Q3, but at lower volumes. Barely a tail left in Q4. The window for finding a strategic replacement is closed. The replacements need to be working right now.
And that's where the counter-narrative, the other side of the coin, really takes hold.
Exactly. How on earth did they achieve that 9.8% consolidated growth, despite the lenalidomide freefall? The only explanation is that they're successfully pulling other levers really, really hard outside North America.
This is the proof, right? That their diversification strategy is actually working, at least as a necessary bandage for now. Just look at Europe. Revenue there grew, get this, a massive 138% year over year, up to 1,376 crore.
Wow, 138%. That's an explosion. And we know, don't we, that almost all of that huge growth came from the acquired nicotine replacement therapy portfolio. the NRT business.
That's right. That NRT consumer healthcare portfolio alone brought in 700 crore in revenue this quarter. Huge chunk of that growth.
And the integration seems to be moving fast.
Very fast. Management said about two-thirds of the business value is already integrated. Places like Canada, Australia, key Western European markets. This isn't just about booking revenue, it's about quickly absorbing a stable consumer-facing product line, something to counter the volatility of complex generics. Next phase, they're targeting Southern Europe, Israel, Taiwan.
Okay, but does this massive NRT growth just mask underlying weakness in their core European pharma business? I mean, if we strip out that big acquisition effect, how healthy was Europe fundamentally?
That's the critical question to ask, absolutely. And the answer is, even excluding the NRT business, Europe still showed healthy underlying growth, about 17% year over year. So that proves the base regional business is strong. It's benefiting from new launches, better market access, not just the big M&A injection.
Right. Meanwhile, the India market, that continues to impress as well. India revenue grew 13% year over year. That's 1,578 crore, significantly outpacing the overall Indian pharmaceutical market growth, which was around 7.8%.
Yeah, really strong performance there, driven by 11 new brand launches, better pricing, higher volumes, and it actually pushed DRL up one spot to ninth position in the Indian market as of September 2025. So not just growing fast, but actually gaining market share too.
This really signals a clear pivot in their M&A strategy, doesn't it? They seem to be actively acquiring stable branded assets now. That's quite a departure from the old high-risk, high-reward U.S. generic play.
Absolutely. You see it perfectly with the acquisition of the Stugeron portfolio. Those are anti-vertigo brands across 18 markets. They paid about $50.5 million. This isn't about beating a patent cliff. It's about buying established cash flow, especially in growing regions like India and Vietnam. They're focusing on stable branded revenue streams in emerging markets rather than, chasing those volatile generic wins back in the U.S.
And the emerging market segment as a whole delivered too.
Yep, 14% year-over-year revenue growth for emerging markets overall. Even the Russia business, which obviously faces ongoing macroeconomic challenges, delivered 28% growth in local currency terms. Strong performance there.
And that growth wasn't just passive.
No, not at all. It was activity-fueled, driven by 24 new product launches across EM in the quarter. So the key takeaway from this whole section is pretty clear. DRL has successfully shifted its center of gravity, at least for now. The pain in North America is real, but it's being entirely offset by strength and strategic acquisitions everywhere else.
Okay, so diversification bought them some breathing room, some time. But to get back those high-end margins lost from lenalidomide, they absolutely need successful, timely launches of their huge pipeline bets. Interestingly, though, R&D spend actually declined this quarter, down 15% year over year to about 7.0% of revenues. Now, isn't a decline in R&D spend usually seen as a bit of a red flag when you're betting your future on complex new molecules?
That's a crucial question, and it looks counterintuitive, doesn't it? The management's explanation, essentially, is that the decline isn't a lack of commitment. It's more of a shift from heavy R&D development spend to execution spend. They're claiming the major development investments for the key biosimilar, abatacept, are largely complete now. So the spending focus shifts from pure discovery and early trials towards complex manufacturing scale-up, regulatory filings, and maybe relying on external partners. That often gets categorized differently.
Right, okay. Let's look at the biggest bet then, the real elephant in the room. Semaglutide, the GLP-1 molecule everyone's talking about. What's the latest on the regulatory status, particularly in their home market, India?
Okay, so the good news for them is that the Subject Expert Committee, the SEC, in India, did recommend approval for the semaglutide injection. However, and this is as a big however, DRL is currently challenging the existing patents in the Delhi High Court. So even with that recommendation, their hands are tied domestically for now. They're allowed to produce and export it, yes, but the actual launch in India is restricted until that patent expires, which is currently scheduled for March 2026.
Okay, produce and export is key, though, because management has publicly targeted selling something like 12 million pens. That's a massive volume. If Canada, which is a key Western market they're targeting, faces regulatory hurdles and the sources hint that might happen, isn't that huge volume projection based on some risky assumptions about less developed markets picking up the slack?
It's definitely ambitious, no question. But management seems to be preparing for exactly that scenario. They sound very confident that even if Canada gives them a complete response letter, a CRL, asking for more data, that volume can be absorbed across the other 87 markets they're targeting. Places like India, eventually Brazil, Turkey. Markets where maybe the regulatory path is clearer or faster, they're essentially betting on the sheer global demand for this drug class and their ability to execute widespread launches quickly.
And looking even further ahead on capacity, they're thinking much bigger than just 12 million pens, aren't they?
Oh, absolutely. Exponentially bigger. They're building dedicated in-house fill and finish capacity at their FTO11 facility, specifically 2 new cartridge lines. These are being built with the capability to scale up to potentially 50 million units annually.
Yeah.
Now, this massive capacity, it's really only going to be relevant after the next 12 months or so, but it's clearly a 5-year, maybe longer capacity bet. It signals they believe in the long-term potential of this molecule, regardless of current patent fights.
Okay, let's turn to the other really high-stakes pipeline asset, abatacept, the complex biosimilar. The timeline here looks pretty aggressive, too.
It is. The biologics license application, the BLA submission to the FDA, is planned for the end of this calendar year, 2025. And the target for approval is timed, quite perfectly actually, to align with the original branded product's patent expiry in early calendar year 2027. This launch has to be successful. It's a critical high-margin product they need to replace that lost lenalidomide income.
Right, and this is where their risk mitigation strategy gets really interesting. Quite sophisticated, actually.
Yeah.
What's fascinating is how DRL seems to be reducing both regulatory and geopolitical risk at the same time.
Yes, they're doing something quite clever. They're utilizing a third-party, U.S.-based contract manufacturing organization, a CMO. And that's in addition to their own Bahupali facility back in India. This dual strategy addresses 3 massive risks simultaneously. First, regulatory risk. If there are manufacturing issues or, say, an inspection failure at their Bahupali site, they can still potentially launch from an already FDA-approved U.S. site. It's a backup.
Okay, that makes sense. What are the other 2 risks?
Second is capacity. It simply increases their overall supply potential, which is especially important for the subcutaneous version, the sub-Q launch, which is targeted for early 2028. That's expected to be the bigger seller. And third,
The geopolitical risk, right?
Yeah.
Which seems increasingly important in global pharma supply chains these days.
Precisely. This strategy prepares them for potential U.S. tariffs or other restrictions on biologics that are manufactured exclusively outside the U.S. It helps ensure market access, even if trade tensions flare up down the line. So this dual sourcing looks really savvy from a risk perspective, but, and it's a big but.
It costs more, presumably.
Exactly. Using a U.S. CMO definitely cuts into the future theoretical margin DRL could have achieved by keeping everything in-house in India. They are consciously trading some peak margin potential for execution speed and, crucially, regulatory and geopolitical de-risking.
But of course, the best risk strategy is only as good as your operational foundation.
And speaking of that critical Bahupali facility in India, the one intended to supply abatacept, what did the FDA find on their recent inspections there?
Right. Well, that facility, which is absolutely essential for their biosimilars pipeline, it received a Form 483 with 5 observations following a pre-approval inspection, a PAI. Now, a Form 483 isn't a rejection, but it is a list of concerns the FDA has that must be addressed satisfactorily. And importantly, they're also still working on addressing a complete response letter, which is a much more serious notification that they received previously for a different biosimilar candidate, rituximab, made at that same site. That CRL is probably the thing keeping management up at night regarding Bahupali.
Okay, so you've got a critical facility, Bahupali, with active 483 observations, A&D, and outstanding CRL for another product made there. That puts serious pressure on the abatacept timeline, doesn't it? Which is precisely why that external U.S. CMO strategy suddenly looks so vital. Absolutely vital. It's their insurance policy. And they saw some issues elsewhere, too. It wasn't just at Bahupali. Their Muirfield API facility over in the U.K. also received a Form 483, this time with 7 observations. So yeah, the regulatory environment remains challenging. It's resource-intensive to stay compliant everywhere.
But it wasn't all bad news on the operational front, was it? We did see some positive updates, too.
Yes, definitely need to balance the picture. 2 other facilities, FTO11, which is a formulation facility, and CTO5, an API facility, both received a favorable Voluntary Action Indicated, or VAI, classification. That followed successful GMP inspections. Getting a VAI classification is basically like getting a clean bill of health from a regulatory audit, so it confirms operational excellence at those key sites.
Okay, good. And finally, let's just quickly connect the dots on those one-time charges we saw. They hit the SG&A line this quarter, making it look a bit elevated at 30.0% reported.
Right. Stepping back for a moment, that higher SG&A figure included two significant one-time items we should probably understand. First, there was that impairment charge we already talked about, the $535 million for the Middleborough facility related to stopping the conjugated estrogen product. Second, there was a one-time provision of about 70 crore. This was recorded for a potential VAT liability in one of their subsidiaries. Now, 70 crore might seem small next to nearly $1 billion in revenue, but when you combine it with the impairment,
It shows they're cleaning house.
exactly. It shows a concerted effort to sort of scrub historical or legacy liabilities now before the big product launches really kick in. The takeaway here is they seem to be taking the necessary financial pain today to ensure cleaner books for that next big growth phase. It looks like a strategic decision, prepping the balance sheet. Hashtag, tag, outro.
So after digging through all of that, what does this all really mean? Our deep dive seems to have revealed a company executing a pretty brilliant, if somewhat painful, controlled transition. The short-term hit they're taking in North American profit margins, well, it's been successfully masked, for now at least. Masked by those aggressive acquisitions, NRT, Stugeron, and by maximizing regional growth, especially across Europe and India. But the entire financial narrative for the next, say, 18 to 24 months, the recovery of those crucial core margins, it really hinges entirely on the successful and timely launch of those high-value pipeline assets we discussed, semaglutide and abatacept.
I agree. And if we try to connect this to the bigger picture, maybe the most insightful takeaway is seeing DRL's strategic shift when it comes to manufacturing itself. That decision to use external CMOs, specifically in the US, for critical biosimilar launches like abatacept, it really demonstrates a realization, I think. A realization that in the complex world of biologics today, execution speed and sophisticated risk mitigation, like having dual, geographically diverse manufacturing sites, are now paramount. They seem to be actively choosing market access security and launch certainty over simply achieving the absolute highest theoretical internal margin possible. It's a trade-off.
That's a great point. And considering the strategic decisions they're making right now, committing massive future capacity for semaglutide, implementing that expensive but maybe necessary dual-source manufacturing for abatacept, it really raises an important question for the future, doesn't it? In this ongoing race for complex generics and biosimilars, is the ability to strategically manage geopolitical and regulatory risk becoming more valuable, perhaps even to shareholder confidence, than simply achieving the highest possible internal margin? Something for you to mull over or explore on your own.